Hello, this is Craig the Options Linebacker. This is the weekend report for Sunday, January 30th. Let's start out by looking at the different index charts. We're going to start with the Dow Jones 30 on the left-hand side. We're going to go to the transports on the right-hand side. The transports are now in a change of polarity. They've actually started making a lower low and a lower high. So right now they've switched into a short-term downtrend. Whereas the Dow is still in a primary uptrend, but I think what you'll recognize here is this shape where we start off heavy from the bottom, we start to slow down, and then it finally goes parabolic at the very end, is very similar to what we see in these types of moves. It starts off fast, slows down near the end, and then we have one last spike higher, and that's where the corrective pattern begins. So I think what you'll find is that the Dow will start to mirror and confirm this initial short-term downtrend as the transports have already started. And as we look at the NASDAQ composite on the left-hand side as well as the Russell 2000 on the right-hand side, this chart has begun the process of making a change in polarity to a downtrend. As well as the Russell, now the Russell has made a lower low and now has a lower high, so it too has confirmed into a short-term downtrend or change in polarity. Now we noticed this divergence a couple of weeks ago as the S&P and the Dow were making new highs, but the Russell was actually had already created a lower low, and so the probability had increased for it to make a lower high at that point. The Russell can sometimes be a leading index. Institutional fund managers have to be a lot more concerned with their ability to get in and out of these stocks because of the fact that they're not as liquid. It's more difficult to get in and out of a small cap stock just due to the lower volume, and if they have to get out of a position, it can be difficult because they will move the market in trying to remove their positions from it. So they have to kind of creep in and out. See this in a couple of ways. We can see the Russell leading to the upside, which is what we've seen this fall. And we could also see it leading to the downside, which is what last week's signal showed. Now let's move on to the S&P 500, starting with a monthly chart. Now, when we do top-down analysis like this, starting with the monthly chart, moving to the weekly chart, down to the daily, and perhaps even the 60-minute chart, this brings us some clarity because it's all too easy to take a day like Friday, where we had a big distribution day, and overblow that and react to that in the wrong fashion. So starting with a monthly chart helps us understand what the overall layout is. And right now, what we've seen in the monthly chart is since really March of 2009, we are now in a primary uptrend, especially after this past December, where the prior swing high was taken out, and we now have a full change in polarity on the monthly chart. So this is not going to just reverse starting next week and all of a sudden lead us to S&P 600 in the next couple of weeks. That's not going to happen. The monthly chart on the S&P is very much like a battleship. You can see that it takes the better part of a year to actually start a reversal process. For a reversal to happen up here, you need to have a lower high, like what we had in the spring of 2008. Now, admittedly, with one trading day left to go in January, we have what looks to be a shooting star candlestick on the monthly chart of the S&P. But as you can see, we've had these before, and really the worst that we're probably going to see from this is just the beginning of a corrective pattern. Whether or not it's just a daily depth corrective pattern or it's a true weekly corrective pattern, that we don't know yet. So we'll go down to the weekly chart and see if we can make sense of this. As we look at the weekly chart of the S&P 500, we brought this out a few weeks ago, that there is tremendous symmetry in these big weekly swings that take several months to unfold. As we started off the bottom in March of 2009, we put in about a 289-point swing to the upside. We drifted back down about 80 points or so, and then the next result was wave 3 to the upside, which was a 281-point swing. So again, very consistent in here. Another 80-point pullback, and then this time wave 5, which is the exhaustion wave, is 176. So this is just perfectly symmetrical. This is almost exactly in line with what we'd expect to see. We did make an ABC pullback to a 38.2 retracement. So again, perfect textbook kind of moves. In the latter part of the summer, we saw a 118-point move up. We saw this move down into the end of August, and then that's the critical point where the higher low is printed, and here comes this big wave 3. Now, what we talked about a couple of weeks ago is that this wave could stretch up to around 1320 on the S&P before it was done. In this case, we didn't quite get that far. We got 263 points and it stopped at a major round number resistance point at 1300. With 2 weeks in a row of negative returns on the S&P, very likely this weekly swing is now over. So now what we get is a couple of different possibilities. First of all, what we could do is we could just walk sideways for this period of time. Walking sideways essentially does the same thing as retracing, but it just takes longer. Now, what can be more effective as far as recharging a chart is actually what's called the slingshot move. So we come down here, that 80-point move that we had talked about, very similar pullbacks along here, about 80-point moves on a weekly pullback, and that'll put us right around the 1220, 1230 area on the S&P. Now, the way things are going to feel if the price retraces all the way down to that level, right now we're at 1276, so that would be another 50, 60 points from here. You're going to see panic amongst the financial markets. You're going to see all kinds of negative press. You're going to see morning coverage on the mainstream media, what's happening in the stock market. You're going to see a lot of worried people, and that's exactly when the opportunities appear in the market. The 4 stages of a market rally are this. You see euphoria at the very end, and you could certainly say that we saw euphoria as of last week. Everybody thought that markets were going to be going up forever. After euphoria, what you see is disgust. After a day like Friday, all of a sudden everybody's disgusted, and this may go into the next couple of weeks, is that people all of a sudden get disgusted as they bought up at the top again. Then what you'll see is disbelief as we see the next rally come up. People can't believe it. Oh my gosh, it's going up without me. Then you'll see acceptance as the market continues higher, and then we'll get into the euphoria phase once again. So markets move like this because it's absolutely counterintuitive to how the average retail trader feels. At the bottom of a move like this, everybody is scared to death. There is no possible way you can ever think about going long at that point. And that's exactly when the opportunities are. That's when the smart money steps in and starts to crush the shorts. Okay, so if this pattern plays out, we will see some type of retracement, perhaps down as far as 1220, 1230, and then we'll see the next wave unfold. And if it plays out the way that this move did, we may see 1400 later on this year. Now, what if I'm wrong? What about if this Egyptian crisis is the beginning of the end? Well, what you'll start to see is that this retracement will be very sharp and will undercut 1220, 1230. So we'll actually see this be a very, very steep retracement and create a lower low. And so it's going to undercut this level and perhaps even undercut this level down here at about 1170. That would be the warning shot over the bow that things are starting to change. What will likely happen at that point is we'll see another rally, but this will be a lower high, and then things will roll over after that. The probabilities are highest right now for the blue path because of the fact that the monthly chart is still the main chart to follow right now and is pulling us higher. Know what to do if the chart starts to take the red path, because that might lead to a lower high and perhaps the end of this bull market. Trade defensively, folks. Understand your risk, and we'll see you next week.